Good evening, everyone. Thank you so much for joining me tonight for our first quarter economic update. Today is January 17th, 2023. My name is Ryan Herbert. For those of you that don't know me, because I do see we have quite a few people on our call today. Like I said, my name is Ryan Herbert. I am one of the owners and financial planners of Prostatis Financial Advisor, along with myself, Mike Kinnett, and then our other advisors, John, Catherine, and Andrew. I'm going to get started with our presentation this evening. Everybody, I encourage you to, if you have a question, please type it in the question box, which is kind of down in that little toolbar that you have. Type in the question. I try to answer them as I go along, as I see them. Sometimes I do minimize it so I can see kind of my full screen there. If it's something that I think maybe would be better addressed in person, I'll go ahead and tell you that. But ask questions if you have questions. Really tonight is to talk about kind of what Mike, myself, and our team here at Prostatis, what we think about the overall economy, kind of what we think about what we should see in the markets going forward, and kind of some of the new tax things that have happened, because there was that passage of the Secure Act 2.0 that happened right before the end of the year there. So let's go ahead and get started. Obviously, everybody knows Prostatis. Everybody knows our team. We have lost a few people since this photo and gained quite a few people in this photo. For those of you that don't know me, this is me over here on the end. This is my partner, Mike. Mike and I have been ranked as the top 1% of advisors in Maryland by Forbes. I've been named the 5-star wealth manager in Maryland for the past, I think, 11, 12 years now. We've taught a bunch of classes at Strayer and UMUC and Loyola. Mike and I have, we've been on TV, we've been on ABC, NBC, CBS. We have a radio show on 105.7 The Fan here in Baltimore and 680 AM here in Baltimore, and then on a couple different stations in Florida as well. General disclosure really just says that this is for information purposes only, doesn't represent any true investments. General information purposes only. Past performance doesn't guarantee future results. So this really is my commentary, Mike and myself's commentary on the overall market, the equity markets and the fixed markets itself. Not really a crystal ball, but more of the factors that we consider when we're making market decisions, when we're deciding what to buy, what to sell, whether to hold, whether to move things to cash, whether to use that bond replacement strategy, using those annuities with those return of premium features, what really makes sense for you guys as our clients. So let's get started with the tax side of things. I feel like this is kind of one of the more important things that we should think about. Number one, the Secure Act 2.0, they just passed this act. One of the bigger things is that they increased the annual catch-up amount inside of 401ks up to $10,000 for anyone who makes, for anybody who's over age 62 and between 64 starts this year. They are now allowing employers for those matching contributions that they give you. For years, even if you put 100% of your money into the Roth side of your 401k, the employee contribution always went into the traditional side. Now it does allow it to go into the Roth side. For your kids and grandkids and younger listeners, it allows employers to make matching 401k contributions based on how much the student loan payments are, even if the employees aren't putting money in to their 401k. Really, this just allows them a way to save money, allows the company to help save money for them when they're focusing on paying off all those student loans that a lot of people have incurred. Another big change is the annuity option. For years and years and years, inside of the government's 401k, the TSP, the Thrift Savings Plan, there's always an annuity option that has been offered. Basically, on the side of their statements, it said, based upon how much money you have inside of your 401k today, inside of your TSP today, once you reach age 65, you can expect this to produce $1,522 a month, or however much it shows. Basically, that's showing them annuities. So changes that are coming to 401ks is it is going to start showing you the annuity options inside of your retirement plans, meaning if you were to take your money and hand it over to an insurance company and say, just pay me an income stream for the rest of my life, and I never want to have access to my money again, here's approximately how much money you could receive upon reaching a set age. That's a pretty big thing. You know, really, the government is really trying to push to get the reliance of the U.S. taxpayer off of the government, meaning be less reliant upon Social Security and really shift that risk back onto themselves and back onto private companies. Another thing that is very, very important is now they have once again changed the RMD rules for you, and they've changed the RMD rules for your kids. When they inherit your money, they really have changed the rules around. If you guys remember, you used to be able to have the option to stretch out your kids, would have the option to stretch out your IRA over their lifetime. They've made a lot of changes to that with Secure Act 1.0, I'll call it that. They put that 10-year rule in place. Now, Secure Act 2.0, they've changed it again. There's lots of different scenarios. So if you want more information on the RMD rules when it comes to your kids inheriting your money, please give us a call in the office, and Mike, myself, Catherine, John, Andrew, we'd be more than happy to go over those rules with you in person, kind of to your specific situation. But for you and your significant other, they've now increased that RMD age up from 72 to 73 for anybody who reaches age 72 after December 31st. So basically, anybody who reaches age 72 this year, your RMD is now 73, all the way up till 2030. If you reach age 73 before January 1st, 2030, this RMD rule applies to you. And then 2033, that age jumps again to 75. Really, you know, Secure Act stands for Setting Every Community Up for Retirement Enhancement. That's what the Secure stands for. Really, what Mike and I like to joke is that it stands for securing an income stream for the IRS, because what they are doing, they're changing around the RMD rules for your kids so they can get your money out of your IRA faster from your kids, so that way they can get more tax dollars. More importantly, what they're now doing is they're saying, hey, let's let the taxpayers leave the money inside of their 401ks, their IRAs, their 403bs, their 457s, their TSPs. Let's let them leave that money in there for a longer period of time, because the longer we let them leave the money in there, the more potential growth that is in there. So now, instead of getting our RMD on a smaller number, we're getting it on a larger number. And they're not adjusting the factors based on your age for how much your RMD is calculated on. They've left that the same. So now they're saying, let's make your number bigger, and the number that you're supposed to divide by, let's make that smaller. So what they're doing is they're making the RMDs potentially larger numbers by encouraging you to leave your money in these plans for a longer period of time. The larger dollar amounts that get you to take out, what does that mean? Larger taxes that they can now get out of your accounts. Think about the trillions of dollars that are in retirement accounts inside of the United States. I don't think that they're done trying to access these accounts, trying to access those tax dollars. Trillions worth of dollars sitting in these pre-tax accounts. This is why having the conversations about Roth conversions has been something that Mike and I have been talking about across the board with a lot of our clients. Does it make sense for you? How quickly should we do it? What's the right amount? How much is it going to cost me in taxes? And more importantly, what are the ramifications across the rest of my tax return for doing these Roth conversions? Once again, if you want to have those conversations with myself or Mike or any member of our team, please just call the office and we'd be more than happy to discuss that with you. Next, really getting into kind of the meat and potatoes of what we think is going to happen in the markets. Really, the thought process is that we're going to have some volatility through this year. We're going to continue to see this little bit of a bounce that we kind of saw at the end of the year. I really think that's going to continue. But we're going to bounce up and down, but I do expect us to have some type of solid trend upwards sometime this summer, early fall, really kind of looking late May, maybe August, just really based on the timing of when the Fed started raising their interest rates to get inflation under control. That process typically takes 12 months to a year to 18 months, and that's kind of really where that puts us, right around June, August of this year, before we see some normal, I'm not going to call it normal, but sustained upward movement in the overall market. The biggest thing to really watch out for is the debt ceiling. The U.S. defaulting on our debt would be catastrophic to the markets. Once again, the government's probably just going to kick the can down the road by putting a temporary stopgap in place. Let the next generation figure it out. Let's just push it down the road. We'll think about it in 2 or 3 months. That's kind of what my thought process there. So really what we see, what the Federal Reserve has been doing now for over a year, they've been trying to raise their short-term interest rates just enough to bring down inflation without causing a true recession. Really what they've been calling a soft landing. That's what they want to do, a soft landing. Basically what they're saying is we can raise rates enough, the economy is strong enough, it's not going to cause a recession. We did end the year on a little bit of uneven footing. Some data, when we talk about jobless claims and consumer spending and the unemployment rate, really is showing that the economy is in really good shape. However, there are some other aspects of the overall market that are not showing the best when we're talking about the measuring of manufacturing, or the number of hours that employees worked, or how confident small business owners are in the overall market. They're not as rosy as, like I said, consumer spending is up, jobless claims are down, the unemployment rate is the lowest level that we've seen. We added 223 jobs in the month of December, which is a very healthy number. Unemployment is down to 3.5%, near the lowest levels we've seen since the 1960s. The labor market appears tight, meaning there's competition for jobs. Very robust jobs growth that we're seeing, albeit lower wage growth, is really making the case for that soft economic landing. But what I'm looking at here, this is a different type of indicator, really an indicator for overall job growth. What it's showing us is that the temporary help employment has, we saw this huge run up, and now it's starting to peak. And the number of people working multiple jobs has risen pretty significantly, the highest level since March of 2020. That's kind of right in this range right here. That's kind of right where we've hit. That's kind of the start of the pandemic. Really what this is saying is that, yes, more people are getting employed, more jobs are being taken, more jobs are being filled, but the number of people taking on a second job or a third job to cope with inflation, that number has been increasing. More people taking on more jobs to help pay for milk or gas, or, I think I saw that the price of eggs the other day was $8.99 because things are that much more expensive. So yes, jobs are getting fewer out there because more people are taking those jobs, but how many of those jobs will really be taken by one person working more than one job. When I look at other points of the economy, like I mentioned, manufacturing. So the blue line that we have here, this is the manufacturing output. The other one here is non-manufacturing, so services. We're seeing both of these falling kind of towards the end of December, almost into contractionary territory in December. Really, this can be argued either way, that this is a bad thing because we're not manufacturing as much, services are falling, but maybe we're not manufacturing as much because we are now starting to slow down the pace of inflation. People are not buying as much because money has become more expensive. The cost to borrow money has become more expensive. Supplies are starting to build up. The whole supply and demand. Supplies are starting to build up, which starts to lead to companies lowering their prices to help sell some of that demand. So, the fall off right here that we're seeing, because we had this big peak, is understandable, simply because the Fed's aggressive tightening, the aggressive raising of the interest rate, that is the point of what it's supposed to do. It is supposed to try to bring down that supply, overflow that supply side to lower demand, to bring inflationary pressures down. And it is expected that corporate profits are going to start to slow, simply because they're selling less and less of things because things have become so expensive and supply starts to build up again. At the same time, these companies still have way more pricing power than the Federal Reserve would really like. Many companies responded to inflation very quickly by raising their prices very rapidly, not doing it gradually, going up very rapidly. They did this because soaring manufacturing costs, soaring input costs for them, but they've been slower to adjust their pricing to the downside. Really, this is kind of what we're seeing. Here's where the S&P 500 is, the pricing is gone, and then here's the operating margin slowly coming back down to be in parity. And I've had clients ask me about inflation and do I think that prices will go down. My answer to that is they're not going to go back to where they were, those pre-COVID levels, because like I said, they've been slow to adjust the pricing on the downside, simply because they have now conditioned the U.S. consumer that paying an exorbitant amount of money for milk or for eggs is the norm. Unfortunately, most people go to the store now and you complain about it, but when you're buying groceries, you have to buy groceries. You're not going to decide not to buy milk when your kids need milk. You're not going to decide not to buy eggs when you want to bake something. If you need those things, you're going to buy them. So I do think that we see prices start to come back down to somewhat normal, but we're not going to go back to where they were. But we're still not at pre-pandemic levels. We're only kind of back to the mid 2021 levels. So this, once again, this is kind of to be expected. It's not a very positive sign for the overall economy, but it is expected. It is an expected effect from what the Fed has been doing to try to bring inflation under control by raising interest rates. Interest rates are another conversation, that we have, particularly when it comes to CDs. Should I buy CDs? Should I buy the I bond? What do we think is really going to happen with that? And what the overall market is feeling is that bond or interest rates, short-term interest rates, will peak at some point. In the Federal Open Market Committee, this is kind of what what we're talking about here, will peak sometime in 2023, more towards the latter part of 2023 into 2024. What these dots really mean are, according to economic projections, where the Fed funds rate will actually peak. Right now, the estimate is somewhere between 5% and 5.25%. That's really this number here. That's kind of where we're seeing more people. And then this is kind of where it sees the rate becoming as we get into 2024, 2025. So we do expect high interest rates throughout the rest of 2023 and into 2024. Each of these dots that we're seeing is what each of the Federal Reserve policymakers have their target for by the end of the year. So, what we're seeing is the target here. The majority of them think it's going to be around 5.25. Some of them think it's going to be 5.75. Over here, one person thinks it's going to be still 5.75 in 2024. So that's kind of what we're seeing here. Interest rates are going to continue to be high. While there has been some positive notes in the bond market, with bond prices kind of popping up a little bit in the first part of the year here, causing interest rates did kind of fall on some of the bonds that you could buy. Really, it kind of points to the point that Mike and I have been making, is that bonds are not the best place to be right now, because if you think about bond prices, that's one end of our seesaw, and interest rates on the other end of our seesaw. As the Federal Reserve raises interest rates, that one side of our seesaw is going up, where interest rates are. The other side of our seesaw is now starting to fall. That's bond prices. So if the Federal Reserve is going to continue to raise interest rates throughout the year, next year and into 2024, like they say they are, bond prices are still going to be a negative aspect of the market, which is why we utilize those bond alternative strategies. They've worked out really well, providing a lot of protection in this volatile market that we've seen over the last year of 2022, doing exactly what they're supposed to do by not allowing any losses. That is exactly what they're there for. When we see a rebound in the stock market, they do collect a significant portion of the upside of the market. Some of them even go up to 150% of the market. But really, they are there to provide that safety net that bonds are supposed to provide in falling markets. Throughout 2022, bonds did not provide that safety net, because as the stock market was falling, interest rates were rising, which caused those bond prices to continue to fall. At one point, bonds were down almost 22, 23% in the year. Now, moreover, kind of what I think is that the Fed is really looking forward, planning to raise interest rates to high levels and then hold them there. So that way they can be sure that inflation starts to fall off. At some point, short-term interest rates will need to converge with the Fed funds rate. They need to get back to that rate. So we'll have that happen really, when we see the short-term interest rates, 2-year interest rates really get to that 5.25, 5.75 targeted rate that they have, that historically has shown us to be the peak of the Federal Reserve's cycle. That's where they're going to stop. In the long run, I do expect inflation to continue to ease, allowing the Fed to eventually start easing back when it's tightening. The pricing that we've seen for wholesale goods has started to fall back. We've seen lumber drop. We've seen gasoline fall back down. We've seen natural gas come back down. We've kind of seen signs of softening in the services sector. Prices are falling. Hiring is falling in services. But what we see here, this is the ISM service index. This provides us inflation about factors for total output in the service industry, gross and inflation. Really, this is non-manufacturing kind of what we're seeing. So, we're seeing the overall services index kind of start to fall off. Prices in the service industries, they did peak in 2021 and have continued to fall through 2022. That's a good thing, because prices have started to go down. But overall, new orders have started to fall off. and employment has stayed pretty steady. We did see a little bit of a tick down, but once again, these are all expected impacts of the Federal Reserve raising interest rates to try to bring down that inflation. The service sector is a very large part of the overall U.S. economy. So seeing this slowdown in it does give us a little bit of caution, but like I said, some of it is really expected because of everything the Fed is doing. There has been a strong start to our global markets and emerging markets to the year. This is really what we've said. It's only been, what is this, 3 weeks, 2.5 weeks into the overall year. But right here, what we have seen is this is the Chinese market. This was it right here, this yellow line, this was it 2022, ended down almost 20%. This year, it's off to a solid start. 2022, we had a bear market against, the war in Ukraine, the central bank, the Federal Reserve raising interest rates, and overall slowing economic growth. China itself was just devastated because of all of the zero COVID policy that they took, all the lockdowns. The index, the Chinese stock market index, reached its low, an 11-year low in October. And then in November, you can see here, this is when they finally decided the zero COVID policy is probably not the way to go. Let's open up the economy or open up the country. Had a pretty strong rebound in their market once that happened. Really for the start of the year, that market is up, this is the best start to the overall Chinese markets since 1995. So there is positive news out there that the overall global economy is finally starting to get better now that inflation is finally becoming under control. China being one of the biggest producers of stuff. Yeah, anything you pick up looks like it's made in, has that sticker on there that says made in China. That is really starting to open up. So that economy should continue to grow, which kind of reverberates around the world. One thing, and this part is taken with a grain of salt because this is data that comes directly from the Chinese Ministry of Transport. Economic activity in China really seems to be multiplying, meaning that there are still a lot of orders going into China for manufacturing. The world needs to buy stuff that China is producing, which in turn is good for the overall global economy. This is a road congestion map here. And what this shows us is this was right around November when they finally started to open things up. Congestion in China had slowly been dropping off. Huge drop here when they went back into all those lockdowns. And then right here, road congestion in China has gone back up, which really means that demand for their goods, people are more willing to travel. People are more willing to spend money there because things are not as bad as they once were. Signs of the renewed demand for Chinese products is really showing up across their country, across the world. The demand of circuits to China from Taiwan in the month of December rose by almost 25% over the month before, meaning that China is now starting to demand the goods that they once did. Steel and iron ore prices have risen 20 to 30% over there because of the anticipated demand from China to start manufacturing those goods. So the fact that China has started its reopening really has been a boon for the emerging markets so far this year. The S&P 500 has started its rise from October. October really seems like it was the bottom, could potentially have been the bottom of the market, and that's kind of how the portfolios are positioned at this point. So, I think that overall, we're going to have this up, down, sideways movement in the U.S. stock market, in the S&P 500, in the Dow Jones, in the overall economy, we're gonna have this movement for the beginning part of the year into, like I said, midsummer to early fall. That's kind of what we're seeing. You know, U.S. companies' profit margins are going to continue to shrink. That's simply because, you know, they're going to have to start lowering prices so that way their supply doesn't become this huge inventory problem for them. That's kind of that whole supply side economics. You know, really what we're looking at is using indexes, using segments of the market that have maintained and still expect to have those strong profit margins. You know, those are the companies, as the economy slows down to this soft landing, those are the ones that should really continue to lead. When it comes to bonds, overall, we're still using that bond replacement strategy, whether we're using CDs, whether we're using those index annuities with the return of premium features on them, or, you know, new conversations that Mike and I have been having about using certain types of notes out there that give us the downside protection that we're looking for with some of the upside exposure, while keeping the overall time commitment on them short, simply because it looks like we are nearing the end within the next year and a half, probably 2 years, of the Federal Reserve stopping the interest rate hikes, holding that rate in place. So then we should be able to transition out of these bond alternative strategies and move into traditional bond allocations. When we start to go back, we're really going to be looking for shorter duration bonds, because those are the ones that are going to have responded the quickest to these interest rate hikes. Those are the ones that are going to see the most amount of interest out them. And then at that point, it really will be, you know, going back to the traditional bond allocation. You're going to see, as some of these policies start coming due, start maturing this year, because 2023 is the date, the year in which we targeted when we started doing this, start coming out of this, moving some of the money from these fixed positions over into overall equities, you know, kind of having that entire buy low concept in place, that now we are near the bottom, at the bottom of the overall market. Once we see this upward trend in the market start to come into play, late May, June, July time, you know, we're having that buy low and taking advantage of that upside of the market. And that is about everything I have for you guys tonight. I hope everyone was able to follow what I was talking about and understand it. If you have any questions, please feel free to give me a call in the office. Here's my number, 410-863-1040, or you can email me directly, Ryan at prostatisfg.com. But we are coming up upon tax season, so please be on the lookout for our information about how to get us your documents this year. We really are striving to have everybody upload their tax documents into our tax specific portal and not into the overall Prostatis portal. That way, everything's in one place and it really can streamline that process. You know, once again, thank you so much for being our clients. Thank you so much for referring us your friends and family. We really cannot grow and do the things that we do without the support of you, our clients, and Mike and myself and the rest of our team. Really appreciate it. Like I said, any questions, give me a call in the office, 410-863-1040. And I wish everyone a happy new year, and we'll start seeing you in the office soon for taxes. Thank you, and have a good